It's the Real Estate Podcast, brought to you by ANZ Home Loans for financial well-beings.
Good morning, Veronica. Last week I talked about how over the past 12 months, many borrowers stayed on variable rates, hoping interest rates would ease sooner rather than later. Instead, repeated rate rises have placed more pressure on household budgets, and some people are now questioning whether they have missed the ideal opportunity to secure certainty with a fixed loan.
Well, I think we always make better decisions in hindsight than we do in the present, don't we? Now we have the benefit of all the information and all the things that have happened that have surprised us, and we now know that inflation was sort of rising anyway. So I guess towards the very end of last year, there were some signs and there was talk change from further interest rate reductions to increases. Simple fact is, yes, if you didn't fix last year, you probably did miss the window. I think we need to get used to a bit more of a volatile environment at the moment.
Yeah, because I said last week that, yeah, sure, there's certainly everybody's chasing the best possible deal. There can be that greed factor, but, you know, a lot of people are on the margins, on that thin margin where you get these increases in the rate and then it makes it very, very difficult to get that mortgage payment made. So you've always really got to be looking at that insurance factor.
I'm risk averse, so I know what I do personally, but a lot of people would rather sort of chasing cheaper rates. But everyone has their own individual approach, I guess. Even when you're talking to mortgage experts, nobody puts their money on the line, really, if you're taking their predictions. So I think we always need to be careful when we're making decisions around fixing or keeping variable. We have to be careful that we can actually afford a few interest rate rises at any time that we make these decisions.
Some of these investors are becoming more selective while others are focusing heavily on rental yields, cash flow and long-term positioning rather than short-term capital growth. From your end of the market, Veronica, in Sydney, what are the Sydney property investors actually doing right now in this current market of conditions?
Sydney's not been booming, really, even though we've copped a hit in the last few months. Sydney hasn't been booming in the last few years. We've had a very flat market for 2 years in terms of price growth. Rents have been increasing, so the actual yield has sit pretty flat at 3% for the last couple of years. So I don't think anybody's been really looking at the Sydney market thinking that it's about to take off, or they're not necessarily buying with any short-term gains in mind. People who buy in Sydney, which is obviously Australia's most expensive property market, they're buying because they fundamentally can afford to invest in Sydney. It's an expensive market to invest in. They're generally dealing with a cash flow deficit, or they're negatively geared for quite some time. So they're looking at long-term growth. Now, the longer-term thinkers, that's not really going to change. But, of course, there's a lot of knee-jerking that goes on when things happen in the property market, and sentiment currently is very low. So I would say nobody's buying with any sense of optimism at the moment. And those who are, I guess, opportunistic might see some opportunities coming up that could be advantageous for them.
Strategic decisions. I want to talk about that around selling underperforming assets and restructuring debt, or in fact improving rental income, are becoming more common conversations. So if an investor, let's say for a hypothetical, owns 5 properties, 3 houses, 2 units, and suddenly comes under financial pressure, what do you think are the smartest options available in this market and in that situation?
You know, it's funny, I do personal strategy sessions often for people who find themselves in this type of scenario. And certainly if we cast our minds back to the last time we had an interest rate hike cycle, we had a lot of people that really under a lot of financial pressure. The rents weren't keeping up, and they don't keep up because the bottom line is what pushes rents up is market demand, and that's not necessarily got anything to do with inflation or interest rates. And so we saw a lot of people in this situation where they bought properties when, you know, interest rates were lower and there was no sort of burden on cash flow. What they often think to do is look at the one that's going to ease their cash flow first, but that's really the wrong way to look at property decisions. They really do need to be looking at, well, what are the assets that they hold? It's not always the case that all units perform worse than all houses. It very much depends on what type of unit, where it's located. And again, with the houses, what type of house, where it's located. And some houses that have particularly poor yield might have fantastic capital growth because of the land value. And so you really do need to look at the individual asset and work out, well, which assets, if I hold for the long term, are going to help set me up for the wealth creation, which is the reason I bought these properties in the first place, versus which assets are actually not necessarily going to perform that well. So I like to sort of put them in three buckets, if you like, which is A, B and C grade. And if I looked at all my portfolio and thought, look, I've really got one C grade or two C grades, then they're the obvious priority to look at to sell first. I want to be holding the better quality assets, not the poorer quality assets. A lot of people make these decisions based on cash flow and end up with poor quality assets, or they might sell a property that has done really well for them and might continue to do really well because they're going to realise that gain, and they keep the poor performing assets. So it really requires a very different sort of way of looking at their portfolio that a lot of people don't step back and consider.
You say that you're a long-time listener, first-time emailer, and that you're a 62-year-old and you were happy with your 10-property portfolio asset base. But after the budget on Tuesday, you've decided to sell off 3 properties this year and 3 properties in 2027 and the rest of your portfolio in 2028. You say that you are done and dusted. That is it. The budget has accelerated your exit strategy. You can't see, you say, how this will improve the rental market, especially long term. That is a very interesting email from Graham there in Brisbane.
Yeah, look, obviously very decisive in his response to the budget. I would suggest Graham obviously made a decision that probably needs a little bit more thinking through, because the budget isn't hindsight, so it's grandfathered. So anybody who's already bought an investment property isn't really affected by this legislative change. It's only properties that are being bought moving forward. And I think if anything, it just brings the whole property question into play to say, well, our properties need to be looked at more as a long-term investment and in the sense of, its yield as well as its capital growth. I think a lot of properties are bought on the prospect of capital growth in the current climate. But I think the existing environment also questions, whether you're going to get those same growth capabilities. And I think the government's now predicting, instead of, the 4 or 5% capital growth that we've been experiencing year on year, it's going to probably be more like 2 or 3%. And I'm not sure if that's actually in relation to the budget. It might be more in relation to the slowing of the economy, which is a different scenario in play. As you say, that's how the economy is going to be affected by everything that's happening in the world today. And obviously the Iran war is top of that. So my first thoughts is, for those who have already got investment properties, business as usual, really. It's for the new investors, people who are wanting to increase their investment portfolio. They'll probably just need to do a little bit more homework around what the returns of that property would be.
I get the feeling that perhaps Graham was going to buy some more properties, which may be influencing big time that decision. Now, restricting tax deductions to newly built investment properties only, many investors are now trying, of course, to understand how this could reshape demand across established housing markets and apartments. Tim, how significant could these changes become for investor behaviour and lending activity, do you think?
It's funny, the government introduced this exception to the policy based on that they would get more home builds, but they really haven't addressed the issue of builders, the lack of skilled workers in Australia, and also available land that's been developed. So increasing or allowing, the full capital gains tax as it is today on newly builds probably isn't going to work unless you fix supply. And they haven't really addressed supply. There's going to be a limited amount of new homes built because lack of skilled workers and lack of land that's currently been released. If anything, you're going to probably see an explosion in that space from investors and potentially prices increasing on new homes, which really doesn't address the whole issue of capital gains, which is to try and make homes more affordable.
So long-term property investing, let's look at that, particularly for higher income earners and those using family trust structures. And there's thousands and thousands of these around the country. Some say that the CGT changes may reduce appetite for investment properties over time. How do you read that picture?
Yeah, look, I think no doubt that it will bring into question, again, the viability of property as an ongoing asset class, so, is there a better option other than property? But I think at the end of the day, the tax increase, certainly on trust to 30%, I think is still reasonably within the framework of making a reasonable decision on an investment property. And I think if an established property still makes sense, the small tax increase on the trust, I don't think will change that too much. If it's a good investment, people will continue to buy it. It might bring into question those properties where negative gearing was probably more of an impact than the return on the property itself over time.
And many investors with these multiple properties, they may well be now reassessing portfolio structures, borrowing strategies and future acquisitional plans, just like Graham there in Brisbane is doing. What conversations then are you already expecting mortgage brokers and lenders to start having with property investors after these budget announcements?
Definitely, you will see probably some changes in relation to lending policy. Obviously, on established properties without the ability to negative gear anymore, obviously that will bring into account tax rebates that they were probably relying on to improve their overall tax position. But generally, I think most lenders take it on their existing income, not future tax rebates. So that probably won't be affected too much. I think interest rates are probably going to impact that more than the budget. And we're already seeing that with lenders putting a 3% buffer on, the current rate, which, it's taking it into the 8s and 9s that they're assessing your ability to pay that debt on. There's certainly a reduced number of people that will qualify for a loan for an investment property at the current time. And on top of that, most lenders only take 80% of rental income into account when they're assessing the applications. I think you'll find a lot of those lenders will tighten up a little bit, which will make it even more difficult, as you say, to get finance approved to buy investment.
Grab your weekly dose of inspiration to help build a real estate portfolio. We talk to the best in the business every day. Learn from the professionals and know your property with us.
If you enjoy the podcast, leave us a review on Spotify or Apple and subscribe to the channel. It really does help us connect with more people just like you who are interested or even crazy about chasing real estate. We are independent media playing with the larger online organisations, and our podcast continues to grow because of the audience behind it, people just like you, and thank you for doing that. Talking of emails, Brendan in Cairns, thank you for sending us a note. You are a long-time listener, you say. Every morning you listen with your brekkie. Yesterday you say that your daughter came down for breakfast. We were playing on your phone and your 9-year-old daughter said, "Hey, Dad, you're always listening to that real estate channel. Why?" I reminded her, you say, that power is knowledge and that her father knows a lot more about property these days. You are looking, you say, at buying before Christmas, and you say thank you for being a constant source of information. Let's take you right now to Brisbane and catch up with Jade Fitzgerald. That was an interesting email there that came through from Brendan. I can sort of well imagine, a 9-year-old saying, "Yeah, what's going on?"
Yeah, totally. Good morning, Craig. And yeah, I'm imagining also that she's probably looking for a Barbie-esque style McMansion, and what they end up going out and looking at might be vastly different from that. I spend a lot of time with families and love when the kids come along and we start choosing their bedrooms and things like that already. It's always good fun. But yes, I'm sure she's always wondering, what are they actually talking about?
Yeah, it just sort of goes over the head. But you actually raise a really good point, and that is when a child goes into a property to buy, because the rental might be slightly better than the property that they're buying, a 9-year-old, 10-year-old, they'd be thinking, hang on, we're sort of downgrading here.
There can be a little bit of that, yes. And a lot of what we do is assisting the mums and dads while we're out looking at property. Lots of the time, kids get a bit nervous when they're shopping around for house shopping as well, obviously. And they worry about school changing and, whether they'll still have the same friends and all those sorts of things. So while we're out and about, we actually do try and spend a bit of time with the kids and take them through different rooms and get them a bit excited. The hard thing is then is if we put an offer in and we're not successful, and then we've got to explain okay, well, that one wasn't for us, but we're moving on to our next one.
I know that she's probably listening with a lot of interest because we're talking about her, and that always shifts the way that somebody will listen. Now, Brisbane continues to outperform most Australian capital cities, even as higher interest rates and global uncertainty starts affecting confidence. Now, I'm interested in your thoughts here. Dwelling values still rose strongly through April, although the pace of growth is beginning to moderate. This is for Brisbane. Is that the case that you're finding where you are?
Yeah, look, there definitely has been a bit of a shift in the market. The dwelling values have still risen 17.3% annually into early 2026. So we're still seeing a strong performance and one of the stronger performance across the East Coast capitals. But what we are starting to see is that the pace of it has just started to slow down a bit. The pricing itself is just sort of, I think, coming in a bit more in line with the rest of the market, where we're not seeing this crazy urgency to purchase. Whereas before, you'd be lucky to have a real estate agent return your phone call. I'm now receiving upwards of sort of 10, 15 phone calls a day from agents wanting us to come along to their opens. So what we're just seeing is a bit of a softening in the market of how many people are out and inspecting, but the pricing itself is still seeming to track with its growth as been performing throughout the rest of the year.
Buyers agents in Brisbane, Jade, they are increasingly warning clients not to confuse a slowing market with a falling market. Yes, many say that good quality homes in tightly held suburbs are still attracting strong competition, particularly in affordable and middle-priced market brackets where demand remains extremely strong. Is that what you're seeing?
Yeah, 100%. And there's still less houses hitting the market than there are buyers out there searching for them, especially in the PPR market. We're still seeing really strong interest and growth in families searching. And yes, the buyer's agent space, it's an interesting one. We've got more and more players in the market as well, which is always fun. And it's interesting when you're out in the market now and you sort of tend to see families walking through with their buyer's agents, which is always fun and interesting as well.
We connect you to the best real estate information across Australia. The Real Estate Podcast.